When you get your direct deposit, your tax refund, depositing cash in the bank, what actually happens with that money through the financial system? That is what we're going to be talking about today, guys. Now, this video was triggered from my kids wondering exactly if they put money in the bank, do they get the exact money back, the exact coin, the exact currency that they did put in there? And that is not the case. So when you're putting money into the bank just does not stockpile it in a back room, waiting for someone to go ahead and come and take that money back out. So putting $100 in there, whether it's a cash, whether it's check, or something else like direct deposit or automatic transfers that are coming into a bank account, it quickly gets broken up so the financial institution can actually use those funds. Now, a small amount does have to stay on hand. Roughly 3 to 10% of all deposits on hand has to stay there. For larger banks, for example, they have to keep 30 days worth of funds on hand. This is in case anyone comes to do withdrawals. They physically actually have to have money to give you back. Now, the problem that we see with some of the financial institutions, we're going to talk about it in a little bit, but in addition to having the availability of funds to actually give out, a lot of the money is loaned out. So when you look at corporates, corporations, larger companies, when you look at smaller companies, business loans, all of this is paid out to other institutions in the form of loans. So they take your money in, they give you a very small margin of interest. The rest of the money that you're providing them actually gives them the liquidity to have and be able to make loans for businesses that run the nation. Now, in addition, this also gives us the ability to lend money out to individuals. When you look at, auto loans, when you look at unsecured loans, when you look at mortgages, when you look at pretty much any loan under the sun, especially when it comes to credit cards, putting money into the financial institution, they are lending the money back out and they are hoping to make a return on that. So essentially, if you deposit money into a financial institution and let's say they're paying you a 5% return, they have to lend that money out much higher than that 5%. And that little margin that they have in between there is what they do for the operating expenses. And that what covers essentially the money that is earned in a financial institution. Now, this is where it does differ quite a bit, guys, because when it comes to banks, banks are for profit. Banks have shareholders. Banks have a lot of different fees associated with them, which makes them money. That is really the way that they have a steady flow of income and how the bank does make money. Now, on the flip side, with credit unions, they are not for profit. So it is an entire different structure. A majority of your credit unions and your not for profit credit unions have the ability to offer lower rates. They have less fees. They do offer higher rates on savings accounts, higher rates on CDs. This again is because not having the shareholder aspect and being kind of member owned, it gives us the unique ability to actually pay you back more money. Now, banks also stash deposits in government bonds and securities that pay interest. Now, the problem that we see, and if you've seen, guys, we had our fifth, that is right, guys, number 5 of the national banks that have failed. I think this one was Citizens in another state. I think it was Iowa, if I remember correctly. But this was because of the government bonds that really failed. So what is happening, guys, is a lot of the banks put money into government bonds and securities at a certain amount of money. They buy government bonds. Well, what has happened over the past years, almost 2 years at this point, the Federal Reserve has raised rates incredibly fast, and older, longer term bonds have less value. So essentially, to think about this is if I buy a bond for $1,000 and the rate is 2%, all of a sudden the Fed goes up to 3%. Chances are there's no one that is going to pay that $1,000 for the bond that is paying 2% because they can spend $1,000 and buy a new bond that is paying 3%. So the financial institutions are sitting on bonds that are now less valuable because the new bonds are paying a higher rate of return. So with the bank sitting on thousands, tens of thousands, millions of dollars, billions of dollars of bonds that have lost value because the Federal Reserve raised rates so rapidly, they all of a sudden get to the point where they can no longer be liquid. And because of this, banks have to sell those bonds. Now, when you come to get your money back, the bank typically reaches into the reserves. They pay you back with the cash on hand. However, in rare occasions, and this is where the banking crisis comes in, on rare occasions, the bank might not have enough cash to cover your withdrawals. When this happens, that individuals or corporations are taking large amounts of money out of a financial institution, the bank does have to sell some of the securities. They sell the treasuries, they sell some of the bonds to get quick cash. But if they are at such a disparity that a bond that, let's say, they paid $1 million for is now worth 600,000. If they need to come up with that million, they're going to have $400,000 to come up with to cover the sale of the bond, or they're going to have to sell more bonds to cover that expense. And the cycle, you can see how it is going to really be detrimental and really bad really fast if there are large withdrawals. Now, if there are enough banks or enough withdrawals during that, small scales definitely can happen, but it goes out of control when there are extreme cases. This is what happened, of course, with Silicon Bank earlier. Depositors took out $42 billion in a 24-hour period. That was enough. The banks sold all of their bonds and lost $2 billion in bonds. That is right, guys. So not only did they have all of these government bonds, which of course are issued by the United States government, but because of the rising rates and the amount that they had to sell in bonds, they lost $1.8 billion, which was enough to, again, just wipe out the entire institution and not provide liquidity, meaning they didn't have the ability to get the cash to go ahead and pay those back. Most of the time, this doesn't happen with financial institutions. When you give the bank money, they put it back into the economy. They put it back into lending, taking deposits very, very short term and allowing them to lend them for a longer term is what the financial institutions are kind of based on. So again, when you're putting your dollar into the financial institution or a $100 bill, your paycheck, whatever it is going into a big collective pool. That pool is what they are actually lending out to other individuals that are looking to borrow money. Now, again, some of the things that we're seeing right now when it comes to financial institutions is one, CD rates, guys. It is one of the best times that I know from being in a financial institution for almost 16 years. We've seen CD rates today that were at 6%. That is right, guys. It's kind of crazy to see CD rates at 6%. But what that means for us as individuals is there's been a lot of people pulling money out of cryptocurrency, pulling money out of the stock market, and pushing it into CDs. Now, it gets to the point now where the Federal Reserve seems like it's going to be pausing interest rates, that we finally kind of rose up, hit a peak where we're going to stay with interest rates. But that also means that the 10-year treasury bond starts to go down, and also that some of the money is now getting pulled out of financial institutions. It is going back into the stock market. And I believe for the last 13 days, I think I read that the stock market has been doing incredibly well. And it's its best performing like 13 days or 2-week period that we have seen in almost 3 years for the stock market's performance. And again, that is because all of this money seems to be flowing back into the stock market, where it was all pulled out in the stock market in 2022 was roughly down around 20+%. That is because all the uncertainty and all the money was pulled from the market, putting it into other things, which was very advantageous at the time because there was a lot of uncertainty and they wanted to go into guaranteed things like bonds. Even looking at I bonds, I believe they're over 5% right now. But again, that is kind of in comparison, because when you look at the landscape and looking at CDs paying 5-6%, even looking at shorter term investments, even high yield savings accounts are paying 5+%, which is kind of crazy in conjunction to what they're paying in the market in comparison to what they're paying for rates at financial institutions. Now, of course, when you're putting money into the financial institution, guys, always do your research. Make sure they are secured and insured by the FDIC or the NCUA to make sure that your money is safe in there. Now, again, 92% of people with bank accounts, kind of interesting to see the journey that your money does take through this whole financial system. But guys, that'll do it for today's video. If you like the content that I'm putting out, go ahead and subscribe to the channel. Give it a thumbs up. Let me know in the comments what you guys think. And as always, thank you guys for watching.